Welcome back, auditing friends. The next thing we're going to look at is weak audit procedures. They're the big mistakes that students make. So, inspect supplier invoices. Well, it's an audit procedure, but it's not one that's going to score any marks at all in the exam. Your answer should say, inspect supplier invoices for sure, but say why. So, for purchases near the year end, so you're saying how really, be more specific. So, I'm looking at supplier invoices near the year end. Then I'm saying why, to determine whether they've been correctly recorded in the appropriate period, ensuring compliance with the accruals concept, if that's what I was looking for. So you'll notice what I did was I said how to do it and I said why I was doing it. I was linking it to a specific risk. Keep going then with our weak audit procedures. Inspect the asset register. You now know that's terrible. So you've got to say, be really specific, say how to do it. So inspect the fixed assets register and physically verify the assets to confirm their existence, because presumably that's the risk that I'm looking at. Do they actually exist or not? This ensures that assets recorded in the financial statements are not fictitious or duplicated, but really exist. You've stated how you're going to do it. You've stated why you're going to do it. Perform analytical procedures on revenue this time. So again, it's not enough. You need to say how you're going to do it. So could be compare current year revenue trends with prior years and with industry benchmarks. Why? To identify the unusual fluctuations that may indicate revenue manipulation. And then you could go on to say if they do, investigate significant variances by reviewing supporting documentation and discussing with management. How, why, specific risk. Key takeaway number 1 then, state the procedure clearly, saying how you do something. So inspect sales invoices and match them to dispatch records. So really clear, really simple, state how you're doing it, what you're doing. Key takeaway number 2, explain why it's necessary. So not just the explaining clearly how, but why. Such as to confirm that revenue is recognised only when goods have been delivered. That's what IFRS 15 wants, isn't it? Key takeaway number 3, always link it to the specific risk. So how, why, link to the specific risk that you're worried about here. So it could be anything, obviously, but here we've got the company has aggressive sales targets. So what is the risk? Well, there's a risk that they're going to bring revenue in early to meet those targets. So what have we got to do? Review sales invoices ensures that revenue is recognised in the correct period. You could be more specific with that, around the year end, that sort of thing. Okay, so you should be getting an idea now of what it is that the examiner is looking for in audit procedures. So you've noticed, or the scenario's told you, there's a high level of obsolete stock. Your old answer would be, yes, I'm worried about valuation of inventory being too high, so I'll check that inventory valuation. Your new answer would say, how are we going to do it? Well, we'll review the aged inventory report and compare it with prior periods to look for, is there any slow moving stock? So compare it, if it says 200 days and normally they're only there for 20 days, you know that there's obsolete stock. Then you say, right, I'm going to discuss with management how they've accounted for this and whether provisions have been brought in, because that's the risk that I'm worried about. We're overstating stock, so have they brought in a provision to get rid of the obsolete stock? What about if it says there's lots of year-end discounts being given away? So you're thinking to yourself, well, there's lots of year-end discounts being given away. They really want to meet revenue targets, so they might be bringing in revenue early. Your old answer would be review revenue records then. Your new answer would be very much more specific. How? Well, let's get a sample of year-end invoices, corresponding contracts, to ensure that they have been brought in the right time, that the performance obligations have been met, they're not bringing in sales too early. Okay, key takeaway number 4 I think is important. This kind of helps you. We know what we do, how, why, link to specific risk, but also just to help you finally, avoid vague terms. So try not to use check, review, or confirm. Sometimes you can use those, But generally, when you're doing the how, if you're putting in check or review, you're probably not explaining how, because you want to say, well, how do I check? Or what do I review? Or what is it I'm going to confirm? So what if we've got larger receivables than expected? Your old answer would be, well, we check the outstanding receivables to see if they're all okay. What we've got to do, though, is say, well, what do you mean by check? Well, get an aged receivables listing. Compare it with cash receipts in the future. Are they actual receivables to determine the likelihood of recoverability? Discuss with management why we've got such long outstanding receivables in there, and do they actually need any provisions? Final one we're going to look at then, high loans, low cash. What are you worried about here? Particularly if it's high loans that will be payable within a year, hopefully you're worried about going concern. So what you used to write is, oh, I'm going to assess going concern. That's what you should do. Check going concern status. Your new answer would be, I'm going to review the company's cash flows for the next 12 months. That's how I'm going to do it, and assess whether the assumptions they've put in are reasonable, because obviously they're going to make out they're a going concern. Then I'm going to verify the existence of the arrangements by inspecting the loan agreements and seeing if there's chances of renewal. So I'm going further and further into it. I'm linking it to the risk. I'm saying how, and I'm saying why.